As was mentioned in Chapter 1, business transactions have to be written down, have to be recorded. In the accounting world, we do this in a certain way, and Chapter 2 discusses this process in some detail. For every transaction in accounting, as I mentioned, the transaction must be recorded. We use what are referred to as T accounts to record these transactions. It's literally a T, and I'll show you on the next slide what it looks like. But the left side of the T account is referred to as the debit side. Debit means left. And the right side is referred to as the credit side. Credit means right. So whenever we record a transaction, we record it into something that looks like this T account, the cash account. If it's an increase in cash, it would be recorded on the left side. If it's a decrease in cash, it would be recorded on the right side. So for each account, we'll have a T account, and a collection of all the T accounts is referred to as the chart of accounts. We will have accounts for our assets, our liabilities, our equity, our revenue, and our expenses. So remember, assets are things that we own. Liabilities are those whom we owe. Stockholders' equity is the owner's or stockholders' right to the assets of the business. Stockholders' equity is also contributions by the owners in the form of common stock, and retained earnings is the amount that is the income that is retained in the business. Dividends represents payments paid by the corporation to the stockholders. Finally, revenues, of course, are sales of services and or products, and expenses are cost of doing business. So the process of analyzing a business transaction and writing it down is referred to journalizing. So in this particular chapter, we'll be journalizing business transactions in the form of a journal entry.